Hi, I'm Kevin Bassett with Bassett & Associates, and our firm does tax planning for privately held businesses all across the country. And our goal is to lower our clients' effective tax rates. Now, one of the ways to do that is making sure that we're capturing all of the deductions of the business owner. And we call that pre-taxing your lifestyle. So let's go through some of the components right now of how you pre-tax your lifestyle. So as your business makes money, the owner can benefit in many different ways. We've got traditional compensation. We can capture office type expenses, auto expenses, those kind of things. And what that allows us to do is make a lot of those things deductible and lower your taxable income, and therefore you'll pay less tax. So let's start with traditional owner's compensation. How we pay ourselves is really a tax decision. Now, one of the things the IRS requires, if for example you have an S corporation, is you do have to take some reasonable payroll. So paying yourself via payroll is something the IRS requires, and we're going to pay as little as legally possible, and we will pay income tax and payroll tax on that amount. Now, we're also allowed to do certain benefits. Most benefits to the owner, employee benefits, are deductible. Not all of them, but most of them are. And so some examples would be retirement plans, health insurance, life insurance, disability insurance, and even long-term care insurance. Most of those are deductible. Two exceptions would be life insurance are not deductible, and Roth retirement plan contributions are not deductible, but those can be paid by the company if they're part of a company plan. Next, we have what we call office expenses, and we break those into two categories. One is home office category, and then just other expenses that come along with maintaining an office. So let's talk about home office expense. We can deduct the expenses of our home quite safely. Years ago, this was considered a red flag, but Congress rewrote the code section pertaining to home offices, and even a handful of years ago added what's called a safe harbor election that makes it even safer, and in fact they cannot audit it if you elect that method. So you've got two methods. If you do safe harbor, you can write off $1,500 a year to capture the expenses of working from home. And additionally, you do not have to pay any capital gains on the sale of your home if you're claiming a home office, if you take that safe harbor method. And you can still take the old methods, which is where you take the business square footage of your home office versus the square footage of your entire home, use that percentage to multiply it by your real estate taxes, mortgage interest, utilities, etc., and come up with a deduction that way. The catch on that, of course, is you don't get the same audit protection. And when you sell that home, you might have capital gains on that sale. There's a final thing you can do to capture the expenses of your home, and there's actually a provision that allows you to deduct 14 days of rent if your business rents your home for company purposes. Besides home office, we can take other expenses, things like owner's cell phone, home internet, the cost of the office furniture in that home office, if you have to use a security system or cleaning for that, and postage, shipping, office supplies, all those things can be deducted in a way to pre-tax your lifestyle. Now, your final category is very common and can be a very large write-off, and that's the use of company auto. Now, the majority of our clients, with the exception of a few in New York City, do have an automobile, and if you have more than 50% usage, your business can own that automobile, and you can take the business percentage of all those expenses and write them off. Now, the fact that you're a business owner is going to make some of the cost of that ownership of that vehicle deductible and lowering your taxable income again. So again, if you have more than 50% business use, you can have it inside the company. Trucks that weigh more than 6,000 pounds can give you a really good write-off. If you have a vehicle weighing less than 6,000 pounds, you may or may not get a better tax deduction by leasing the vehicle in the business. And then finally, if you have a car that you're going to keep a long time, be very inexpensive to operate, like a Honda Accord or Toyota, and you're going to have a lot of miles, you might be better off owning it personally and taking the standard mileage rate. We give all our clients a vehicle decision matrix to use when they're purchasing a vehicle. So you put all those together between traditional compensation with owner's wages and benefits, home office expenses, general office expenses, and writing off your vehicle. These are all ways you can pre-tax your lifestyle.